Where should you allocate your savings or surplus monthly cash flow? Well, the most important considerations are your investment time frame and also the taxation of both the product and the structure that you purchase the product in. In terms of your investment time frame, let's look at this chart produced by Vanguard, which gives us a good understanding of how different assets perform over different durations. Typically, when you have a shorter investment time frame, you'll have a much higher proportion of investments in things like cash, term deposits, and Australian and international bonds. Why? Well, we can see here with this cash line here that there's no volatility. It's going up in a positive trajectory. With bonds, there is a little bit of volatility involved, but you can see this blue line is relatively upward facing as well. Now you can see the average rates of return for these two asset classes have been about 4.2% to 5.5% over the last 30 years. So because you're not incurring volatility, the average rate of return is lower than, for instance, shares and property, which are up here. So therefore, if you have a long time frame to invest, often you'll have a greater proportion in things like shares and property, which have returned between 7 to 10% over the last 30 years per year. However, to get those really good rates of returns, you do need to accept volatility. So you can see there's been periods such as the GFC in 2008-2009, or in COVID in 2020, or even more recently with rising interest rates and wars around the globe, where markets have gone down sometimes between 5 to 40%. So therefore, if you had a portfolio fully made up of shares, but you need the access to the money in the short term, your portfolio value could be at risk over the short term. So that's why we marry up an individual's investment time frame with the asset allocation to make the best decision. Next, we need to consider the taxation of each investment and how they can be owned. We always need to consider the after-tax benefit of any investment strategy. If we look at this table here and specifically this line with the after-tax benefits, we can see the comparison of if we invest across different structures. In this situation, I've put in an investor being at the 47% tax rate, so the highest marginal tax rate, and they have a home loan of 6%, and they otherwise could be invested in a high growth manner. Now, if they put their savings or surplus monthly cash flow into the offset account, they would benefit by the interest rate, because there's no tax that they have to pay, so they would merely be offsetting the 6%. By contrast, they could put money into an investment bond or a company and invest there, and given the tax rate of companies and investment bonds are a maximum of 30%, the net rate of return would be 7.97%. Now, in all these examples, I haven't included capital gains tax because often those capital gains tax events can be managed with different strategies, and it's possible that you might not even sell these assets. Next, if we look at the personal investment, you can see that even though the rate of return is the same across all these different investments, the net after-tax benefit is a lot lower with a personal investment because his marginal tax rate of 47% is a lot higher than either the company tax rate of 30% or the super tax rate of 15% or the pension rate of 0%. Now remember that most people aren't eligible for this 0% tax rate within pension until they stop working after age 60 or become age 65 and they can still be working. So for many people this option is not in play, and so one of these four options could be. Now the best after-tax rate of return then we can see between these four is 8.43% in superannuation. However, one of the downsides with super obviously is that it's locked away until generally you reach age 60. So if the client wanted the funds sooner, we then need to work out what is the time frame and which one of these would be suitable, and work out, is access to the money and time frame more important than finding the best after-tax benefit rate of return. Now we can change this scenario however we like it. Let's say we had someone who wasn't working, then the equation actually switches. So now it would be best to invest in their personal name up to a certain point, below the tax-free threshold. So really, it's all about the individual and what strategy would work best for them in terms of their taxation and their investment timeframe. Now, given all the variables that we've gone through, there really is no one-size-fits-all approach to where to allocate your surplus monthly cash flow or savings. It really is best left to an advisor to guide you on that decision. To book in your obligation-free initial appointment, click the link below.